Folks, welcome Alena from Aegon Asset Management, which manages like $300 billion of assets worldwide. You know it better as Transamerica Insurance Company, now merged with a global investment management company. She manages the Impact Venture Credit Strategy, which provides structured, flexible capital solutions. And she and I both believe that the creative financing is key to funding a lot of climate initiatives. Next, we have Shashank, who is, I'm not even going to try the last names. Chief Investment Officer at Marcetta Capital, which is a London-based multifamily office. They have put a couple $100 million into climate solutions, a couple $1 billion into climate solutions. And he's also a partner with Nextwave Capital here in Los Angeles, which is a family of thematic funds, one of which is their food and agriculture fund invests in the future of eating. We all like eating. That's anchored by Chipotle restaurants. Meghan Pasricha is the managing director for decarbonization and energy at Riverstone Holdings, which is a leading private equity firm investing in real assets and infrastructure. And Meghan is building their decarbonization credit platform. She's going to tell us more about what those three words mean when you put them together. So my first question to I also have to say, Meghan is the CEO of a nonprofit which has trained 20,000 youth leaders in climate activism worldwide. And Alena and Meghan are the co-founders of Women in Climate Investing and Finance. So our partners in getting this all together. My first question for all of you is, tell me about an investment you recently made that you're excited about. Alena, why don't you go first?
Okay, so the last investment we made, and I'm Hold this, okay. Hi everyone. So I would say our last investment is Unagi scooters. Why I'm so excited about them? Because they provide a solution for micromobility and allow people to drop their cars for the last mile kind of transportation that now a lot of people are working remotely or in dense cities like New York City using train and then need to commute to the office from the train station. So it's like 1 mile, 2 mile kind of ride. And after COVID, we don't want to share our scooters, right? And for a lot of us, it's a pretty pricey item. So Unagi is providing a subscription model. So now everyone who has 50 or 60 bucks to spare a month, they can subscribe to receive a beautiful scooter that is light, can get you anywhere. And what I like about them as well is they work with large corporations like Google and make them to pay for that subscription for their employees. So if your employee is providing you membership reimbursement for the gym, ask them to switch it to maybe some micromobility solutions.
Now, remind me, what was the name of that scooter?
Unagi.
Unagi.
And you will never forget it now because if you ever watched Friends, that's exactly good, yeah.
All right, Shashank, tell us about something cool.
Cool investment was a fusion energy company.
Fusion Energy, yeah.
Commonwealth Fusion Systems.
I saw that in Back to the Future. There's a little Mr. Fusion thing in the back of the car, right?
Exactly. Cheap. They've done really well lately. All their research has been on track, and basically they're still on track technically to have commercially viable fusion hopefully by 2035, which that happens is really cool.
All right. Let me ask you a follow-up question on that. How do you measure success in climate investing?
That's a tough one.
Because 2035 is a long, it's a while from now.
Yeah, it's a really tough question because lately, there's a lot of controversy on greenwashing and what does ESG mean. And the family offices, as well as even on my own venture side, we start to kind of we've been deploying hundreds of millions for years now in ESG and impact and sustainability, but we more recently started taking quantified our approach to how much CO2 is actually being taken out by our investment. If you measure it by just CO2 or the supply chain, 25% of all CO2 emissions are food and ag, this food and ag supply chain, fertilizers, and then another, I think 18% are steel, another 17% is plastics, cement is another 15%. So, these are massive, massive markets, also with a massive profit potential. So, we're trying to take a quantified approach to what sustainability is and where we're helping, and that doesn't necessarily look like what you would think. It may be even, working with oil and gas companies to make the supply chain a little bit greener. I think success looks like, are you actually changing existing supply chains into, a better version of themselves? Some things that are green and sustainable, traditionally speaking, may not actually be sustainable, like wind turbines. When you take that kind of quantified approach, a wind turbine is the amount of plastic, cement, and steel that go into a wind turbine, not to mention the trucking and everything to ship it out to wherever location you're building it. You're actually in a net deficit of carbon for about 14 years. The average lifespan of a windmill, a wind turbine, is about 30, 35 years maybe. So you're actually in a CO2 deficit for half of its lifespan. So, that's how, if you're going to measure success, just understand what success is.
Okay, so count the carbon atoms. Great. So Megan, tell us about an investment you made that actually pushes us toward a greener future.
So one of my favorite investments. Now it's on. One of my favorite investments.
Oh, hold on, Shashank and Alena, point your things backwards. But that they won't get.
I can also scoot
or
further
turn
away.
off at the bottom.
I'll use this time to say that these are my views and not my firm's views because they asked me to say that. So one of my favorite investments is a community solar investment. And there are two reasons that I liked it. One, it was our first green loan and exit at the firm. So we were able to use the proceeds for something that was clearly green energy. The proceeds were used to actually buy the solar panels that would enable the company to build a community solar business. The second reason I love it is because I'm a little bit more of the contrarian on the panels, so I invest in real assets, and then there's always a technology component to it, but I'm not doing straight climate tech investing. And this was an investment where you have the hard assets, you have the solar panels, it's a well-established industry, but then the community solar piece of it is actually giving people, let's say, who live in cities where they can't put solar panels on their rooftops or on their land. Like I live in Manhattan, so in my apartment building, I can't put a solar panel anywhere. And so I can actually choose with my electricity bill to opt into local solar and wind access. And so when it's available, Con Edison or whoever will choose to switch onto the grid that's more renewable and green, and you actually get a reduction on your bill. So it's kind of a win-win when you look at lending from an infrastructure and hard asset perspective, but also the technology that gives access to people who wouldn't necessarily get access to cleaner, greener energy.
Okay, so where does this all money come from? Magically, there's some limited partner in your fund who has identified the climate as an important. Is there a lot of money in climate investing right now? All right, so Alena, what is climate investing? What does impact investing mean?
If we are talking about broader concept of impact investing, I think it's always very important to distinguish between ESG and impact, because it's getting commingled together in completely two different things. So if you break it down, ESG is what companies are doing internally with their governance, how they're running their business, how they're treating their employees. So it's what good they're doing for their company, how effectively they're running the company, right? When we are talking about impact, is about how this company affecting community around it, how is it affecting economies around it, and what are they doing to improve life around itself? So outside the organizational impact. And in my opinion, climate investing, impact climate investing, is going even deeper. So at Aegon and our team, we define impact investing as we invest in products and services that this company provides that solve some kind of a problem that exists. So you're investing into the technologies that are scalable. They will be this company will able to provide access to these technologies to not just like high income families like Teslas of the world, right? No, not everyone can afford it, or if you can afford it, you need to buy a very expensive battery, you need to upgrade your panel. So how those technologies, when they scale, can be affordable to people that are really affected by climate change, which is lower income class, middle income class, or someone even living in poverty, right? So for us, we're looking at the cost parity with existing solutions for that specific problem and trying to understand if we will put 10, 20, $100 million in this company, are they able to scale and get this technology to the masses? Are they able to actually solve and not just avoid carbon, but maybe they can actually reduce the carbon emissions that is already in the environment? So there are like a lot of different factors when we are talking to different prospects, and that's kind of how I define impact. It's like what actually good your company is doing for the community, for the city, and for the global kind of society in general. So that's what impact investing is for me.
All right, so now these massive changes that we're looking for in society take a lot of money. And Shashank is the venture investor in the panel, but Meghan and Alena are the debt investors. So Meghan, I'd like you to tell us about how debt plays a role in scaling up solutions.
Sure. So at Riverstone, we're investing on the debt side in green loans or sustainability-linked loans. And it's been interesting because we really had to think about the definition of impact. You know, on the sustainability-linked side, you might be working with a traditional energy company, maybe even oil and gas, that's moving forward towards that cleaner and greener future. But you can't call that impact because you're still working with oil and gas companies, right? So it's a really interesting kind of bridge that we're standing between right now to get us from point A to point B. But I think there is a lot of capital in the space, and then it's about finding the right opportunities. So we serve as the bridge between once the technology has been proven up, but the company's not large enough to get access to a bank or a high yield investment. They need kind of a bridge loan to get them to commercialization or constructing a larger plant. And there are a lot of components of that need to be set up on the earlier side. For example, are the revenue contracts set up for high growth or for and scalability, or are they set up for more stable growth, and that would get you better access to the lending market? And so it's really interesting, right? The debt side is cheaper than getting more and more equity, and a lot of the founders like that they're not giving up so much ownership, but it has to be at a certain scale where they can finance and sustain the debt.
So, Shashank, you told us about a fusion research company, which is like a little way from product market fit today. And what is it about investing in, well, now it's called deep tech, but it used to just be called tech, investing in frontier technology as opposed to software solutions?
Yeah, I guess like, so the family office side, we do a much later stage. We do infrastructure. We do, actually funding like, kind of $50 million plus tickets. But then on the other side, I've worked with a lot of charities on helping grant money, writing grant checks to, top university research. So MIT, UCLA, a few others. And so for me, I think what I'm tackling with our kind of, corporate capital-backed funds, like the Cultivate Next, which is backed by Chipotle, that's kind of the valley of death. So there's a lot of money in grant world where researchers it's philanthropic, it's governmental funded, there's plenty of money there. And then increasingly earlier and earlier, but there's a lot of money in Series A plus, kind of where they take over, where they can lend. But there's a huge gap always still to be solved in multiple areas of kind of seed to Series A, where you need commercial viability, you need to prove commercial traction. So the way our venture, like Cultivate Next, the reason we have Chipotle as our only LP, sole LP, is because they are the customer. So you're actually getting validation on the commercial side by the potential customer of the technology, whether ranging from fertilizers to alternative proteins. So, we invested in an alternative protein company called Meaty that was it's all mushroom-based meat company. We immediately are giving them like a pilot in Chipotle, right? So you are investing, but also acting as the customer. So I think your question was frontier tech. Why do it or how do it? How to do it? I think
it was a good answer either way. It was a good
I would say, like, my point. You can validate frontier technologies, whether it's food and ag or space, which you're involved in, Shanti, like by getting smart people like you to validate the technology works enough. But then, great thing about investing early stage is you get to work with the founders, mentor them, coach them, help them find product market fit, get them customers in addition to the money that you give, and then hopefully their organizations can take over and write the bigger checks, and my family offices and stuff too. So, yeah.
So you talked to. It's always a trope, of course, when you have investors. Your investor's business model becomes your business model. But Alena, you run an investment fund, so it's not your money that you're investing, it's someone else's. And what are their objectives through your fund?
I mean, it depends LP by LP. So if we are talking about currently Transamerica providing us with the capital, for them, it's actually creating a pipeline of technologies and investing to get to their zero carbon goals as the corporation. So as we know, insurance companies are one of the largest LPs into the industry in general, not just climate. And because they've been around for so long, there are a lot of investments in oil and gas assets, right? So now you need to divest that and need to replace that with something that is more climate friendly and get them to that carbon neutrality and potentially negative carbon footprint through the investments. And companies like Transamerica Life Insurance, they're managing our retirements, right? Our money, we're trusting them with that. So when people care and you guys actually go in and checking your 401ks and what indexes have been invested, your money are getting put in, and when you make that choice to switch from S&P 500 or something that is not aligned with your personal interest, you are pushing those large corporations to actually open their eyes. It's like, oh, people want that, there is a market for that. So that's talking about large companies like Transamerica. Other LPs is just, again, people like me and you potentially have a lot of money running large successful companies. They want to diversify their assets. They see a big future. There is a big regulatory push for clean solutions, a lot of tax incentives. It's from right now where we sit, it just makes sense. It will make you money. Investing in non-climate friendly solutions will not make you money. And that's how things got our reality now.
Wow, that's great. So let me ask you a question. How many people in the audience are investors? We have, right, good. Megan, is there a lot of money going into climate investing right now?
There is.
And so
that's the end of my answer. No.
Yeah, of course there is. Now presumably there's a difference between let's build another solar farm, and someone bulldozed my favorite poppy field in the Antelope Valley to put in solar. I'm very sad about that. But what's the difference between like those arbitrage kind of easy to justify deals versus taking a risk on a breakthrough technology which would change the game? And we heard in the remote sensing panel about how measurements completely change the math. Like Dave did not give himself nearly enough credit about how finding the 5% of people who are using half the water in LA County and fixing their leaky water meters saved us in 2017. What's the balance between easy stuff and potential game changer stuff?
Yeah, I think the math, right, the numbers and being able to measure the impact of where you're putting your money is going to be even more important. So one of the things we talked about is how long time horizon is your investment. If we look 5 years from now, 20 years from now, can we actually measure what the impact was? And I think, so our loans are actually shorter tenors, so they're 3-year tenor, but 12 to 18 months expected life. So we get out very quickly, and we have to be able to measure the impact of it, the returns of it. So it has to have a financial impact as well as either sustainability linked or green. I think it's going to be a challenge because let's say 5 years from now, you make an investment, you get out of it 5 years from now, and if you can't measure what the impact was, it's going to make it very challenging. And you're going to have some investors who might want to pull back or put their money somewhere else. So setting up these investments from day one to be able to measure the impact is really important. I'm probably not the right answer on the breakthrough technologies because we do need that technology to be proven up, and we also need hard assets to be able to provide a loan. So I'll hand it over to everyone else. And one other thing I'll say is that Shashank mentioned the unintended consequences of some of these investments, and I think we have to start thinking about that now, right? If the wind panel is going to be thrown into a landfill somewhere, then maybe there's a company that can start to recycle those, and maybe that's the investment you want to make. Like thinking 5 years, 10 years from now, that's a great place to start putting money now.
Go for it.
And one other thing I wanted to touch on was even the framing of is there money in sustainability or kind of in this space. I actually think that framing we should depart from that because in general, these companies are all just investing in their own kind of commercial spaces. Like I said with Chipotle or any of these, it's just a matter of investing in the next generation of meat or next generation or whatever. I think whether it's oil and gas companies or anything, I think naturally companies have surplus in the profits. They need to reinvest it in their own supply chains to continue to evolve and grow. And, especially with government regulations, especially with the new technologies coming in, there's ways to improve their bottom line and, increase other profit streams. I think that's the best way to look at it. So when you frame the situation as such, you're not just some do-goody sustainability investor, you're actually just investing in pure business. And then, sure, you should calculate and track impact and ESG, not only to track your impact from a PR and shareholders perspective, but also, it's you can kind of market that. So, but.
All right. So in the previous panel, we heard Trevor from Planet say, if you can measure it, you can manage it, which has never been more true. So to what extent do investors invest in measurement, or is that all on the company?
Great question.
Alena, I'm going to give that one to you.
When we're looking at the prospect deal, the new opportunity, we always dive into all the impact, positive impact statements they've made and ask them to prove that what they're saying is true. And how it's done either through them having what they call life cycle analysis, where they go through the supply chain, they go through how they run their company, they go through even as far as where their product goes and how that customer is handling recycling part of it, or how they what they do with that product at the end of their life. So that's a huge part of our due diligence process, and we always keep companies accountable to that. So if we will see that it's not there, nothing supports their statements, we will walk away. Even if it's from financial returns, it's just amazing. We will walk away. And while you're managing, you already invested, yes, we have KPIs on a quarterly basis that the company is reporting upon, and we again asking to prove with the data points to show that it's not just assumption out of the air, and they're actually showing that performance of those KPIs. And I think as an impact investor as well, I do care about our exits and what that exit mean. So if they're doing M&A transactions and they're looking to be sold, I want to have a say as an investor to who are they being sold to. Like, will that new kind of owner of that technology and that company has alignment of interest for this technology and that solution, or they're buying it just to shut it down because it's a competition. So I think as an investor, managing those exits as well is a very important part of our overall thesis. And it's all about the data. There are a lot of technologies that measure it. Who is paying for it? Most of the time is a company, unfortunately. If you have a big pockets as a fund, or you're running more like over $1 billion, there are funds that incorporate scope 1, scope 2 on the portfolio level. They hire carbon accounting firms to do that work and dive in and build the models. So it just depends what size of the fund it is, how much actually they can expense and use for that. But there are a lot of people there that on the portfolio level trying to measure scope 1, scope 2, and sometimes even scope 3 if the data allows for that. So, yeah.
Wow. So, Meghan, you gave us an interesting framing about how all investing is climate investing, but once met an investor who said, I bought some more RJ Reynolds, and every time I do it, I feel bad, but it keeps making money. So do climate investments, is it acceptable to get a lower return from a climate investment than from, like, I don't know, Remington Arms or something? Well, they're bankrupt, but...
I like that you asked the anti-tobacco activist about RJ Reynolds.
I know. Right. So do your LPs accept some extra risk or cost or slightly lower return because or they just say we're only investing in climate? And
no, it's challenging because they are looking across their portfolio and they have to make the returns, and so you go LP by LP, just like Alena said. Some groups will say, yes, we're willing to take the risk. We have to divest in oil and gas, and we have to be doing environmental and impact. And maybe those groups are willing to take more of a lower return. But the majority of our investors need to, make returns for their investors too. And so we have to make sure that we are getting great returns as well as reducing our risk and making either these green or sustainability linked loans. On the sustainability linked side, it's kind of nice because you can actually have a metric that the company is tied to and your loan is tied to. So everybody's aligned towards at least one metric to measure it throughout the course of the loan. But no, we make sure not to have lower returns just because we're doing more on the sustainability and decarbonization side. The one nice thing is that the space is growing so fast that there are plenty of companies to invest in. Our pipeline is bigger than it's probably ever been, and it's just about finding the right deals, because you definitely can find the right ones where you can get the returns and you can get the impact.
So that still sounds like a lot of work for the startup companies. So Shashank, you work more closely with the founders through your fund. What do you see that startup founders do to, make it look like this climate investment is just a great investment?
So are you asking, what do they try to do to make it look nicer than it is?
Is there essentially an extra cost or risk because they're doing, this new technology that hasn't been done, and it's not just a dating app?
Yeah, if they're purporting to be helping the planet, then we gotta get the technology validated. You put together some great smart people from research institutions to validate that. If that's validated, then you work with the founder to make sure they're more clearly point out the benefits that their company has for the world than they may be able to transcribe. So actually, my buddy Drew Fitzgerald, he actually helped Commonwealth Fusion Systems. He worked with Bob Mumgard at Commonwealth super early when they were just a research project at MIT to make the deck, to make it, be able to describe why do we need fusion. So actually, I noticed the opposite. When you actually source from top institutions and you work with their early stage researchers, I find the opposite problem to be true, which is the technologies are there, the guys are so sciencey that they can't kind of become the marketers. Not everyone's FTX founder. So,
thank goodness.
So, yeah, thankfully actually. But unfortunately, in this case, these are really great technologies. But being able to like get to the succinct two-sentence answer of why do I care is actually their problem. They start talking about the science, and they should throw up a statistical analysis and a regression on why something is good and bad, and you're going to lose the investors. That's actually why Elon Musk has been so successful in all of his companies. Is he cuts through the nonsense on public-facing panels and gets to the question that inspires, gets to the question that tells investors this is a big solution to a big problem, and it's a big market, and boom, 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 you're hooked. So that's actually very rare for someone. That's why he's so rare, because he's someone who understands enough of the science, but also is able to brilliantly market himself and his companies. And so I actually notice an opposite problem usually in these kind of startups.
So Shashank has a fusion research. I actually also invested in a different fusion research company, which will pay off I'm never seeing that money again. It's gone. Any billionaires here? No, just, okay. But that is too long. It's easy for me. I'm investing my own money. I can do that, but that's too long of an investment horizon for an 11-year fund. Is there anything we can do with structuring, Alena, and how deals are put together to buy down risk for the investor for these long-term technology research projects?
Yeah, absolutely. That's why you have different stages of investment, right? You have a venture market, you have a private equity market, you have public markets, right? Each market is catered to specific risk stage and growth stage of companies. So where we play is more on like a venture side between your start to generate revenue up to you're ready for the M&A transaction, IPO, or you just running the wave of being cash flow positive, and it's a great success story, right? So we're right there. Why structured finance is so important is because we're trying to cater our capital structures to specific needs of the company, because there is no company that is the same as the next one. Every business cycle is different. Every need of the founder is different. They're all at a different stage. So when you are looking at Series A and 15 people in this room will say like, oh, okay, without knowing what that business is. So you're raising Series A means X amount of dollars, that's X amount of valuation, and that's the structure. Here is your term sheet. They change the name and send it out. It doesn't work. It doesn't work. In climate tech, it's so capital intensive. To your point, you need to prove technology first that it just works. Then you need to prove technology on the small scale that it works, because if you're dealing with chemistry, if you're dealing with physics, you cannot just multiply by 2 and do it. Like, it doesn't work this way. Then you have a pilot project. It works. People are getting excited. How you scale it to the big facility that you actually can create volume and economy of scale and get that cost down when it's acceptable to the market. Again, it takes time. You need a very specific structure that will be aligning with your milestones, because one plant needs 2 years to be built, another plant or facility needs 10 years to be built, because it's something like highly customized equipment. You need to source supply chain problems, you name it. So that's where the structured finance coming in play. So it's between this debt equity cycle, where a little bit of equity, big chunk of debt, you're looking how, okay, let's main reason when I talk to founders, I always tell them you need to have not a 5-year plan, you need to have a plan for 15 years. If you're raising money right now, what will you need to get in next 5 years to get you from A to B? You need to understand that and spend your money thinking about that. So if you will give up 50% of your company right up front, how are you going to raise the rest of the money to actually scale it? So yeah, structure just allows to be flexible. It's not a cookie cutter solution. You can put debt and equity together. You can do different things, and it's great. I love it. That's why I'm doing what I'm doing. And when we talk to founders, they just seems like they read the same book with all the VCs that are out there. Not all, a lot of them are great. But yeah, we just need to hear, and you cannot just apply the same solution to everyone.
I think one question that comes from that is who holds the risk. So when we're looking at an investment, is it the equity group that's holding the risk if something goes wrong? Is it the debt holders that are holding the risk? Are we covered enough to be able to get our money back even if something does go wrong? And I think during COVID, this became a really important question. And it's important for founders to think this through when they're structuring the investment. So for example, if there are cost overruns or delays, and we saw this in a really massive way during COVID, then who's going to fund that piece of it? And are you set up? Do you have enough cushion? Are you going to need to raise funds when something's going wrong versus when something's going right? So to be able to kind of at the forefront when you're raising money, think through those components of it is a nice way for the founders to think about structure before they actually raise the money.
So
can
have
I add
a lot of
little bit to
runway.
that?
Right? Have raise more than you need and have extra runway, or
at least know the answer to the question. So sometimes you'll have an insurance wrapper on something, or sometimes there will be, if you're doing a construction project, once you have the technology and you're trying to scale it, is there an EPC firm that's going to be in charge if they're, who do we turn to when something goes wrong? So you don't necessarily need the capital just yet, but you definitely need an answer for that question when you're raising capital.
And I would just love to add, again, for founders, you're allowed to ask questions, like you're allowed to make due diligence on the investment firms that give you term sheets. Go there and ask, how many funds do you have? How much money you deployed in this technology? What value are you providing to me? How much reserve are you putting against my investment? Will you catch me while I fall? How are you thinking about my next 5-10 years? Because a lot of funds will not have answers to that because they just want to put 5 million here, 3 million there, and just kind of spread and hope that one thing works out. But you need to do your due diligence as well if it's alignment, because you're basically getting into a very long-term relationship with these people who is investing in you.
See, we mentioned before that there's a lot of money moving into climate investing. And I guess that means it's up to the entrepreneurs to make sure they're matching with an investor that provides a lot of added value and insight. So let me ask a question to the audience. And Meghan, we're going to go to consumer behavior because that's kind of your thing. How much of this is on companies to fix everything and get paid back by charging us all rent of some sort or another? Right? Because everything we're doing is it's collecting rent from the 8-9 billion people, and how much of it is on us humans just to change it? So I'm going to ask you, Dave just left. One thing Earth Optics is doing is verifying the carbon uptake from beverages. So if you had a choice, you go, okay, we're in Los Angeles, you're at a fancy restaurant, they have like this frou-frou menu with lots of adjectives that make you pay too much for the cocktail. Then you have the choice between a regular mojito and a carbon negative mojito. Right. Are you going to spend raise your hand if you'd spend $1 extra on top of the parking fee you just paid and everything else for the carbon negative mojito? All right.
I will ask them to prove me.
Yeah, exactly. I kind of want to know that they're really carbon negative.
Yeah, that's what the satellites are for. And the thing that measures the thing. Anyway, so I thought that was a really cool example, right? That and maybe Chipotle will be future say this, this burrito removed half a pound of carbon from the atmosphere because we use blah, 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 blah. Meghan, do you think that like tying climate solutions to consumer behavior is going to be a thing?
Yes, definitely. So I'm going to take off my Riverstone hat for a minute and truly speak as Meghan, because so we saw this a lot with the tobacco industry and anti-tobacco. So growing up, I was an anti-tobacco activist as like a 16-year-old. And we saw, does it come down to putting warning labels on the cigarette packets, or does it come down to people making individual choices? And what it eventually, at least in Delaware, turned into was a health issue, that young people were the ones who were inhaling the secondhand smoke in the restaurants and the bowling alleys. And when we turned it from, is this a good or bad, to a health issue for young people, it changed the whole story. And I actually think that's what's happening in climate as well, or at least what we saw in COVID. It's not just this is good or bad. It is a health issue, it's an environmental issue, and now a lot of it's coming from consumers, and a lot of it's coming from young people pushing to make that change. So in the community solar example that I gave, of course you can have solar panels there and you can set up the systems, but are people the ones who are opting into it and calling their changing their electricity bills to opt into community solar? That's the individual. So I think you need both, and I love that over the past couple of years we're actually seeing the consumers pushing for this change, and you're seeing the investors pushing for the change, and it's forcing all of us to make different choices with our money.
All right, so we're going to make some time for questions from the audience, because I know you have them. Okay, down here in front first, or the middle. Where we have any working? Yep, there you go.
So as a very specific example, we're in Culver City, and Culver City doesn't give the consumer a choice. Culver City is 100% clean energy, and so they buy from third party. And so in the scenarios that we've been using so far, that it's been individual by individual or building by building, investing in alternative energy. But here you have a situation where we're actually in a city that has made that choice for its residents.
Is that a part of the Culver City brand versus the other 88 cities in unincorporated county that one could buy overpriced property in?
You'd have to ask Culver City that.
So is the question, how does that...
So far you've talked mostly from the point of view of either getting people to vote with their money, so individual responsibility, social responsibility, and ethics, or investing in smaller plans where it's building by building or school by school or office by office opting for alternative energy. But I'm giving you a real example where already this city has made the choice for its residents. So how do you, I guess to form a question for you, how would you work with an entire city?
I've got a story for that. In early 90s, I worked with a casino in Las Vegas to study consumer behavior, collecting surveys, and one of the questions they wanted to ask was, would you like a smoke-free environment? This was Hacienda Hotel and Casino in Las Vegas. And they were able to put together from the market research, a theory of success where they would be able to bring in more people as attraction that would offset the losses from the smokers. And this mathematical basis was what led to the first smoke-free casino in Las Vegas, which then everyone else said, hey, that was actually kind of nice, let's go do that. I think what we see with political structures is it's a culmination of individual behaviors, right? The city does what the people vote for, and to some extent, or maybe it's not the individuals, but it's the people who select the elected officials who collectively...
I'll give you an easier example, because that's all speculation, because that's all we can do, right? Let's take Native American communities, sovereign nations, Native American, Native Canadian, where you have an indigenous community that has all individually voted to go a certain direction. So then you're not dealing with what's the government going to do, but you're actually, the people are actually governing. So how would you approach that?
Well, with regards to power infrastructure, though, one thing I will say is it's actually best done in a group for sure, and at some kind of city or regional level. You can have obviously referendums or however you guys want to take it, but the one fascinating area we've been looking at on the power grid side specifically is the shift to solar and the individualization of power generation. The transition to solar and the ability for companies and wealthy individuals to generate via their own grid, essentially, is actually a very troubling shift on one perspective, which is the power grid is a shared cost entity. It is, and you see what happens when you have smaller grids like Texas. It fails. The larger the grid, the more economies of scale you get. From the beginning of the 1900s, when electricity grids were built, it's always been, we've always taken it for granted that it's actually relatively cheap power. Power is very cheap, and it's the cost of maintaining the power grid is borne by larger corporations and wealthier individuals, and it has always been relatively cheap for most of society. As you see a shift towards wealthier individuals building their own solar plants and wealthier companies trying to be green, shifting off grid, those massive contributors of capital to the maintenance of the grid actually go away, and actually they add further volatility to the grid. Because solar and wind are highly volatile in terms of their kind of when they input and when they aren't inputting. So that's actually a very troubling kind of move. The grid infrastructure across the U.S. is creaking, so that it can't be decided locally. It has to really be decided on a state and national level. But obviously you can have microgrids, but that's the problem. The communities that go with microgrids are going to be wealthier communities and wealthier neighborhoods even that band together. So it's kind of a troubling stat. So that's something to think about. There's a really great book on it's called The Grid by Richard Brecka. You should check that out if that's a debate you're having in your community, because he covers the entire history of the grid, and it's like a very nerdy but like very specific book. Yeah, check it out. I think it tracks the entire problems coming up too.
Okay, Anne in the back had a question.
Yeah, I just had a question. Regarding the role of non-dilutive funding as a way of helping de-risk the tech, because when we work with our deep tech companies, especially around ports, goods movement, transportation, hardware type solutions, the only way moving forward is de-risking is getting national laboratories, port-funded pilot projects, all these sources of non-dilutive funding, and then moving forward. But that really wasn't part of the conversation today. So I'd just like to see how much emphasis you look at these ways of really relying on to help de-risk your investments.
All right, so let me ask another question. How many people here are angel investors? How many people here are investors of any investors of any kind? Right, so 10% of all investors are going to be writing small checks, and like you said, Shashank, there's a valley of death. Have we fixed it? Wait, you have grants.
Yeah, there's plenty of grants. Yeah, I mean, like I said, we worked heavily on the grant side at researching institutions, but when you're talking about sustainability, there's so many avenues. I worked with the X Prize guys. One of my really good friends co-founded the Carbon Capture X Prize with Elon, and through their view, they have a lot of private donors, deeply capitalized, grant platform. But the amount of grants available from DOE and DOD, DARPA, there's all kinds of federal energy-related, manufacturing-related, logistics-related grants. If you go, you can even go on Fiverr or something. There's full-time grant writers that you hire to write for those grants, because it's quite a process. And then I would just there's plenty of lists to compile on, depending on what you're doing, where you're doing it. There's always a grant for it. There's always non-dilutive capital. Yeah. Oh. Oh, yeah.
how much weight you put to that for de-risking your investments.
Oh, have.
Do you even show up before the technology's been de-risked?
No, we don't. But still, even in our portfolio company, we have a company that is like past their Series B, and we actually, through our network, saw a grant that was like a perfect fit for them, and we went and say, hey guys, this is the grant you need to apply for. Of course, it's de-risking because it's basically free money, but it takes a lot of time from grant writing and like just going through the process. It's not about the company, sometimes it's not about the tech, it's about regulatory environment and how much time it takes. So I love to see grants, and every time we kind of through our network seeing them, we're always helping our companies, connecting with the grant writers or pointing them to right people to just talk about it. So yeah, it's absolutely de-risking our investment. I would say we majority of the time come in later, and sometimes when I see that they were getting grants from DOE, for example, for me it makes more kind of confirmation about their tech and their go-to-market strategy. I get that stamp of approval. The same way when I look at their cap table, who is behind these people, who invested on the earliest stage, are they actually experts in that specific field? And if I see familiar names that I'm comfortable with, I don't have PhD, I have no idea about engineering. I can talk about finance all day, but I need validation of other experts in the field to tell me that it works. And grants from very well-known organization, it helps with that a lot. Yeah.
This is also a really
real
unique
quick.
place. Yeah, really quick. This is a really unique place because you have the different phases of the non-dilutive capital. So you have the grants, and then the venture lending, which is earlier stage, and then we're the bridge to get to the bank or the credit bank or high yield financing. So each of us represents a different stage to get non-dilutive funding.